Monday, November 6, 2017, Monaco 64, home of alternative economics and contrarian views. This morning, I'm going to talk about creative destruction. Before that, we'll look at the markets and at the Journal of Commerce Index, which is something very few people look at, but the big money, long-term investors, and even the Fed follow this index very closely. So it's 10 past 8 a.m. in London. So spot gold, 1270, basically unchanged. Range has been 1266 to 1271. Silver, 1688, up 4. Range 1679 to 1691. So precious metals holding in there fairly well. The Dow is down 15 at 23,516. S&P down 5 at 2582. NASDAQ futures down 7 at 62.86. Currency-wise, we've seen a bit of a move in the dollar up against the yen. Earlier on, we got up to 114.74. Now we're back down to 114.25, but still up 20 pips. Sterling and euro are fairly subdued, basically unchanged. 130.81 sterling or cable, and the euro is 116.10. So the Journal of Commerce Index. So a lot of you probably never even heard about it. And I'll read about what it is. It says the JOC-ECRI Industrial Price Index was developed by the Economic Cycle Research Institute and is a leading indicator of inflation based on a broad assortment of raw materials used in industrial production. The IPI growth rate compares the latest week's index with the IPI's average over the past year. So this index, for example, you have to pay for it. Even if you have the Bloomberg terminal, for which you pay a few $1,000s a month, you don't have access to this. So it's something that the Fed looks at, big money, long-term investors look at. And I was sent a chart of this, and I spoke to a good friend of mine who still works in the city. He's the man who hired me when I was younger, when I was working in Switzerland. He hired me to come work with him in London back in 1992. And we speak regularly about the markets almost every day. But so he sent me a chart here, and I want to talk about the Journal of Commerce Index because it might give us a little bit more of a indication where commodities and gold, are going, gold and silver. And you might not like it. I'm not saying that gold is going to drop massively or silver, but at the moment, I think the picture is quite subdued, even though some commodities have risen quite well recently. This Journal of Commerce Index is quite a leading indicator. It precedes moves. So if you look here, for example, back in 1994-95, it topped there, and then it came all the way down and made a bottom in the end of 2001, and that corresponded to the bottom in gold that we saw, the cyclical bottom at $255 or so. And then from beginning of 2002 to like 2008, it was, was going up. I know it kind of popped up in 03, 04. And as you can see, it's kind of relative. Because the top in end of 03 in gold was around $400, and then the top in 08 was at 1,000. So it's like it's a relative measure index. So you can see in 08 that Journal of Commerce Index crashed almost down to 60. And that was in the 08 crisis when gold, moved from just above 1,000 to below 700. And then from 09 all the way to 2014, the index rallied quite strongly. And the top was just above 150, 150.5. And in spite of that, gold, topped in 2011. So you see, it's not a perfect indicator in terms of the highs and lows in gold, but you can see that from that top above 150, it dropped quite sharply to below 100, and that's when, in the end of 2015, gold and after that, a lot of the commodities bottomed, and we've seen a rally up to 126 in the Journal of Commerce, and now it seems to be dropping back down. Ever since it looks like the beginning of 2017. So is it going to go further down? It could. The other indicators that are pointing maybe to a slowdown in the economy is, for example, the yield spread between the 10-year note and the 30-year bond in the US. It's below 50 basis points. It's around 48 now. When the curve is flattening, as they call, it means that the economic outlook is not as strong. Am I saying there's going to be a big collapse or a crash? No, I think things are pointing to a bit of a slowdown, and we could see gold and silver remain, maybe between 1250, 1350, maybe 1400, but we need to see a bit more, of a move in the commodities and in the inflationary picture, in the cyclical picture, it looks like. So yeah, that's the Journal of Commerce Index. Just trying to give you some more indicators here that, and this index, for example, it's on a relative basis. So just because, we went up there above 150 in 2014, it didn't mean to say that all the commodities were higher than they were, for example, in 2007, 2008. So, but it gives you, the direction of things. We need to, I'll keep an eye on this Journal of Commerce, and I'll get updates from my friend and post it again. So creative destruction, go quickly through that. Basically, creative destruction, sometimes known as Schumpeter's Gale, is a concept in economics which since the 1950s has become most readily identified with the Austrian-American economist Joseph Schumpeter, who derived it from the work of Karl Marx and popularized it as a theory of economic and business, economic innovation, business cycle. So basically, the theory is that in a free market capitalist economy, according to Schumpeter from the Austrian School of Economics, you have to allow industries to be destroyed. You have to allow new industry to come into the market, and that's the only way you create growth and prosperity. And why am I talking about this today? Well, because I think big government is too big. Well, it's big government. And intervention has become the norm. Politicians want to get reelected every, few years or so, and they don't allow anymore the economy to operate freely. People are scared, of allowing things to be annihilated, as Schumpeter describes. And the biggest example of, preventing creative destruction was the crisis of 07, 08, when the governments of the West saved the banks, saved the financial system, and in order to make sure that big government, welfare state, warfare state remained. And that's why we don't get productivity increasing. That's why people are still in debt. They wanted to keep the credit bubble going, the credit economy going, the big, fiat money banking system of fractional reserve and speculation and derivatives going. And that's why, in my opinion, we've seen the economies of the West not do well at all. They've done well, I guess, for the people that were supposed to be destroyed. The people on Wall Street, in the city of London, in Frankfurt, these people are still doing well. The people close to the central banking fiat money system. But the real economy is lagging. Wages are down, and politicians are still doing, relatively well. They get their they get huge salaries, the huge pensions, all the perks, and that's why I think we haven't had a productivity increase. And the other thing, the credit cycle or the credit economy is still there. They've created a bubble in higher education by having the government subsidize the universities, and it's all a system that needs to be allowed to annihilate itself, and it's not a bad thing. You need to adapt, and that's why I don't think we're seeing productivity. You look at articles and people talking about it, mainstream economists, they don't look at the bigger picture. But that's why, in my opinion, we haven't seen the economies recover. We've seen the middle class being shrunk because we're stuck in this paradigm of fiat money, huge debt, big government, welfare, warfare. And if we have small government, the politicians wouldn't care about the economy because they wouldn't be involved. That's the ironic thing. But the more they get involved, the more worried they get, and the more creative destruction, the less creative destruction there is. So that's what I think the problem is with the Western economies, and why we're not seeing prosperity for the general public, nor productivity improve in the economy. So if you enjoyed this video, please like, share it, subscribe to my channel if you haven't yet, and you can follow me on Twitter and on steemit.com. I'll talk to you later. Bye.